In October 2025, a new wave of headlines swept across the financial world, each one carrying the same startling message: Miami, Florida, has been named the world's most at-risk housing market. The news came from a respected source, UBS Global Wealth Management, one of the world's leading investment banks. Their global real estate bubble index ranked Miami at the very top, ahead of Tokyo, Zurich, Los Angeles, and Dubai, and warned that the city's real estate boom might finally be showing signs of strain. To some, it sounded like history repeating itself. Nearly 20 years after the 2008 financial crisis, the idea of another Miami housing bubble caught immediate attention and concern. But is Miami really standing on the edge of another crash, or are the headlines missing a more nuanced story? One about a global city evolving, stabilizing, and maturing in ways traditional metrics fail to capture. Today, we'll break down the data, the debate, and the reality behind Miami's housing market, and separate the numbers from the narrative. This is the Miami Real Estate Report, October 2025. The UBS Global Real Estate Bubble Index is an annual report analyzing property markets across 21 major cities worldwide. It's a comprehensive effort to measure when and where housing prices become detached from economic fundamentals, a condition investors often call a bubble. UBS uses 5 main indicators to assess each city's bubble risk: the price-to-income ratio, the price-to-rent ratio, changes in the mortgage-to-GDP ratio, changes in the construction-to-GDP ratio, and the city-to-county price ratio. When a city scores above 1.5 on the UBS scale, it's considered at high risk for a housing bubble. This year, Miami scored 1.73, giving it the highest bubble risk rating of any city in the world. According to the report, Miami's home prices have risen faster than inflation for 15 straight years, outpacing income growth and rental price increases alike. UBS analysts note that the city's price-to-rent ratio, a key indicator comparing home prices to annual rental costs, has now surpassed even the levels seen during the 2006 property bubble. That's an alarming signal for economists. In plain terms, it means that buying a home in Miami has become far more expensive than renting one, and that imbalance, UBS says, often precedes a correction. The report also points to another warning sign: homes in Miami are taking longer to sell. By late summer, the median time on the market for U.S. homes was around 58 days, but in Miami, homes lingered an additional 16 days on average. The result was a wave of mass delistings, as frustrated sellers pulled their listings altogether. By September, that trend had turned Miami into what Realtor.com described as the strongest buyer's market in the country. In other words, buyers suddenly held the advantage, a stark contrast to the red-hot, seller-driven market of the pandemic years. UBS called this combination of stretched valuations, long listing times, and growing inventory a clear sign of bubble risk. The firm warned that while it couldn't predict exactly when prices might fall, the fundamentals pointed to overvaluation. Still, the report stopped short of forecasting a crash. It described Miami's outlook as vulnerable, but not yet in freefall, noting that the city's coastal appeal, low taxes, and international demand remain powerful stabilizing forces. UBS concluded with a cautious statement: while price growth is expected to turn negative in the coming quarters, a sharp correction appears unlikely at this stage. To understand what UBS is warning about, we need to break down a few key terms. A housing bubble occurs when home prices rise far beyond what local economic fundamentals, like income, rent, and employment, can justify. It's often fueled by speculation, easy credit, or investor exuberance. And when those conditions reverse, when borrowing becomes harder or buyers retreat, the bubble bursts, sending prices sharply downward. UBS's global index has a long history of flagging such imbalances. In previous years, it identified warning signs in cities like Toronto, Hong Kong, and London, all of which later experienced significant cooling. But the Miami case, even according to UBS, is unique. Over the last 15 years, Miami has recorded the strongest inflation-adjusted housing price growth of any major city in the index. That's an extraordinary run, one shaped by migration, global capital, and lifestyle demand that few other U.S. metros can match. The median home sale price in Miami now hovers around $635,000, while the median annual rent is about $32,000. That gives Miami a price-to-rent ratio of roughly 20, meaning it would take about 20 years of rent to equal the cost of buying a typical home. Historically, a ratio that high is a textbook indicator of overvaluation. While the data does raise concerns, many real estate professionals and economists contend that UBS's analysis, though precise in its methods, fails to capture the complete picture of Miami's market dynamics. Local experts push back. Shortly after the UBS findings were released, Miami-based experts began pushing back. They argued that the report, while attention-grabbing, paints an incomplete picture of the city's housing dynamics. One of the most prominent voices was Eli Beracha, director of the Tibor and Sheila Hollow School of Real Estate at Florida International University. Beracha believes that UBS's methodology, especially its reliance on local income data, fails to account for Miami's unique sources of wealth. He explains that many of the people buying homes in Miami don't earn their income within the city. Instead, they bring wealth from other parts of the U.S. or from abroad. This inflow of external capital means that the typical price-to-income ratio, a key UBS metric, doesn't accurately reflect local purchasing power. In Miami, Beracha says, we know that a lot of the income that is earned here, probably more than in other cities, is not necessarily reported, so a lot of people are really making more money than it is reported. He also points out that international buyers play an outsized role in Miami's real estate economy. When somebody from Brazil or another country buys a home here, they're not earning the money in Miami, he says. They're bringing their existing wealth here. That wealth, he argues, distorts conventional measures of affordability and reduces the likelihood of widespread financial distress, the kind of over-leveraging that typically causes bubbles to burst. Another local voice, Bozovic, founder of Analytics Miami, goes even further. She calls the UBS report sensationalist and says it uses Miami as clickbait. In her view, focusing solely on the pace of price growth, without considering who's buying and how they're financing those purchases, creates a misleading narrative. Both Beracha and Bozovic highlight one critical fact that UBS's report largely overlooks: the dominance of cash buyers in Miami's housing market. In the first half of 2025, Miami led the entire nation in all-cash real estate transactions. According to Realtor.com, 43% of all Miami home purchases were made entirely in cash. For homes priced over $1 million, that number climbed to more than 53%. This single statistic carries enormous weight. Cash buyers don't rely on mortgages, which means they're insulated from rising interest rates and immune to debt-driven foreclosures. They aren't vulnerable to the same pressures that topple over-leveraged markets. As Beracha puts it, you do not see crashes in housing when people buy in cash. You see crashes when there is over-leveraging, when people borrow too much and then cannot afford to pay the debt. Bozovic agrees, saying that UBS's omission of Miami's cash-heavy market is a major oversight. In her words, ignoring that fact while labeling the market a bubble shows a complete misunderstanding of Miami's fundamentals. The power of cash gives Miami's housing market a built-in cushion, a foundation of real capital that helps stabilize prices even as demand fluctuates. Another point raised by local analysts concerns Miami's housing inventory and rate of distress. Bozovic notes that the city's supply of homes for sale is still below pre-pandemic levels, and its rate of distressed properties, such as foreclosures and short sales, remains extremely low. And that's a key distinction from 2008, when speculative borrowing and mass defaults drove prices downward. In 2025, the conditions look very different. Buyers may be more cautious, and sales may be slower, but sellers aren't desperate. Many have simply chosen to delist their homes and wait out the market, a trend that Realtor.com's data confirms. That patience, analysts say, indicates strong financial footing, not panic. Jake Krimmel, senior economist at Realtor.com, offers a helpful analogy. He says what's happening in Miami isn't a bubble bursting, it's the air slowly coming out of the balloon. In practical terms, that means prices aren't collapsing. They're cooling. Homes are staying on the market longer, an average of 89 days as of September, 16 days longer than the same time last year. Inventory is up 16.3% year-over-year, giving buyers more choices but not triggering a wave of distressed sales. Krimmel says this measured slowdown shows a low level of seller distress, another sign that Miami's market is stabilizing rather than spiraling. As Beracha puts it, after years of rapid appreciation and ultra-low interest rates, a breather is normal. It is natural, he says, that people take some time, a breather, trying to figure out the market. Even as UBS warns that Miami faces the highest bubble risk in the world, the same report contains what some experts describe as internal contradictions. UBS defines bubble risk as the likelihood of a large price correction, essentially, a significant drop in housing values. But later in the same report, the bank's analysts write that while price growth may turn negative in coming quarters, a sharp correction appears unlikely at this stage. To many, that's a mixed message. If Miami is supposedly at the highest risk of a bubble, yet no crash is expected, what does bubble risk really mean? Analyst Bozovic sees that as evidence that the UBS model, while data-rich, may not fully capture how Miami's market actually operates. She argues that the report's own conclusion, that the city's appeal, tax structure, and global demand continue to attract buyers, undercuts its earlier alarm. Indeed, the same UBS study acknowledges Miami's continued advantages. Miami's coastal appeal and favorable tax environment continue to attract newcomers from the U.S. West and Northeast. Real estate prices remain well below those in New York and Los Angeles. International demand, particularly from Latin America, remains robust, especially in the luxury oceanfront condo segment. Those lines tell a different story, not of collapse, but of equilibrium. While price growth is slowing, the underlying demand that has defined Miami for years shows no sign of evaporating. Miami's global magnetism. To understand why Miami keeps defying expectations, we have to look at what truly drives its real estate economy. Miami is not just another American city, it's a global brand, a gateway between the United States and Latin America, a magnet for international capital, and a haven for high-net-worth individuals seeking lifestyle and stability. In the last several years, that global appeal has been reinforced by prominent names and major moves. Soccer superstar Lionel Messi now owns 4 luxury condominiums in Miami, including units at the Cipriani residences. Tech billionaires, hedge fund executives, and entrepreneurs from New York, California, and abroad continue to buy along the coastline, often with cash. Jeff Bezos, founder of Amazon, made headlines earlier this year when he purchased 3 properties on Indian Creek Island, known as Billionaire Bunker, with a combined value of $234 million. These examples underscore what analysts like Beracha describe as invisible wealth, income and assets that don't show up in Miami's local data but dramatically influence its housing dynamics. They can be anywhere they want, Beracha says. But Miami becomes, increasingly, the city of choice that brings here more wealth, more spending power. And that is really the metric. That invisible metric, external wealth inflow, helps explain why traditional affordability ratios don't paint the full picture. While UBS sees an imbalance between local wages and home prices, the reality is that much of Miami's housing demand doesn't rely on local wages at all. The broader context to grasp why this debate matters, it's important to remember how we got here. During the pandemic years, Miami was one of the hottest real estate markets in the world. Remote work, low interest rates, and a surge of migration from high-tax states created a perfect storm of demand. Prices soared at double-digit rates, bidding wars became routine, and available homes were snapped up within days. By 2022, mortgage rates began to rise, cooling the frenzy but not collapsing the market. What followed was a gradual normalization, longer listing times, increased inventory, and a moderation in price growth. That's the phase Miami finds itself in now, what Krimmel calls the slow release of air from the balloon. It's not a panic, it's a pause. A recalibration after years of acceleration. Data from Realtor.com shows that as of late 2025, the median list price in Miami is roughly $499,900, down about 4.8% from a year ago. That's a decline, but hardly a collapse. In fact, such modest corrections are often seen as healthy in overheated markets. The median sold price, as of July, was around $496,000, up just 1.2% year-over-year, essentially flat. Taken together, those figures indicate stability, not freefall. Even UBS's authors concede that Miami's housing inventory is approaching pre-pandemic levels, suggesting that the supply-demand imbalance that once defined the market is slowly easing back into balance. If the data points to stability, why do headlines continue to warn of bubbles? The answer lies partly in psychology. Housing markets are as much about perception as they are about numbers. When prices rise quickly, fear of missing out drives buyers to act. When warnings of a bubble surface, that fear can flip, becoming hesitation and caution. In Miami, perception has always played a powerful role. The city's reputation for boom and bust cycles, from the 1920s land rush to the 2008 crash, makes it an easy target for dramatic headlines. But analysts today say that comparison doesn't hold. The difference, they argue, is leverage. In 2008, many buyers were overextended, borrowing heavily on adjustable-rate mortgages. Today, nearly half of Miami's transactions are cash purchases, a structural safeguard against the kind of systemic collapse that defined the Great Recession. That's why both Beracha and Krimmel describe Miami's current market as maturing, not melting down. It's evolving from speculative exuberance to steady, capital-driven demand. Across the city, you can feel that shift. Realtors report fewer bidding wars, buyers are taking more time to decide, and sellers are adjusting expectations, but not slashing prices. Homes are sitting longer, yes, but sellers remain firm. Many prefer to withdraw listings rather than sell below value. Another sign that owners aren't under financial stress. Data from September shows Miami leading the nation in delistings, a strong indicator of patience and holding power among homeowners. Krimmel interprets this as evidence of a low level of seller distress. Even as inventory grows, demand remains anchored by migration and global wealth. Florida continues to attract residents from high-tax states like New York, New Jersey, and California, a trend that shows no sign of slowing. Miami's absence of state income tax, combined with its climate and global connectivity, keeps it high on relocation lists. Luxury segments, particularly oceanfront condos, continue to see steady interest from both domestic and Latin American buyers. Developments in areas like Brickell, Edgewater, and Sunny Isles are still drawing attention from international investors who view Miami real estate as a long-term asset, not a short-term flip. As UBS itself acknowledges, this international demand serves as a stabilizing factor, cushioning Miami from the volatility that might otherwise threaten its market. Lessons from the data. So what can we take away from all this? First, Miami's housing market has undoubtedly cooled. Sales are slower, listings are higher, and price growth has flattened. But second, the data doesn't point to a collapse. What's happening is a correction, not a crisis. Third, the traditional indicators used to measure bubble risk, metrics like price-to-income and price-to-rent ratios, are valuable but incomplete when applied to a city as globally interconnected as Miami. Those numbers don't fully reflect the inflow of wealth, the prevalence of cash transactions, or the city's role as an international financial hub. Fourth, leverage, or the lack of it, matters. Because so many Miami properties are owned outright, there's less risk of mass foreclosures or distressed sales even if prices soften. And finally, Miami's long-term fundamentals remain strong. Favorable tax policy, international allure, lifestyle appeal, and a steady migration of affluent residents continue to support its housing market. Looking ahead, analysts predict that the Miami housing market will likely continue to stabilize through 2026. Prices may fluctuate slightly, up or down a few percentage points, but no dramatic swings are expected. Inventory should continue to normalize, and the pace of transactions may remain slower than the feverish pandemic years. Beracha summarizes the outlook succinctly. I don't expect housing prices to spike. I don't expect them to fall significantly. I expect them to probably stay right where they're at. Slightly higher, perhaps slightly lower. That's part of the process. UBS's own data seems to agree this. While Miami's bubble risk rating remains high, the firm acknowledges that a sharp correction appears unlikely. In other words, Miami's real estate market isn't breaking, it's breathing. When you zoom out, Miami's story mirrors that of a city coming of age. Once defined by volatility, it's now shaped by resilience. The same forces that once made Miami vulnerable, its dependence on international capital and luxury demand, have, paradoxically, become its safeguards. Global wealth has made the market less reliant on debt, while the city's broad appeal has diversified its buyer base. Yes, prices may cool, yes, sales may slow, but the foundation of Miami's housing economy, real capital, desirable location, and sustained global interest, remains intact. The market that once raced ahead of fundamentals is learning to pace itself, and that's not a sign of weakness, it's a sign of maturity. As 2025 draws to a close, the story of Miami real estate is more complex than a headline can capture. It's not a tale of panic or collapse, it's a portrait of balance emerging after a decade of unprecedented growth. UBS's warning serves as a valuable check, a reminder that no market is immune to correction. But the voices from within Miami, economists, realtors, and analysts, offer perspective grounded in lived experience. They see not a bursting bubble, but a market in transition, cooling from its pandemic highs yet supported by enduring fundamentals. In the end, Miami remains what it has always been, a city of cycles, a crossroads of capital, and a place where the world's wealth continues to find a home. For investors, homeowners, and observers alike, the key takeaway is this: Miami's market may be changing, but it's not collapsing. Its evolution, not its demise, is the story worth watching. From UBS's global index to the streets of Brickell and Coral Gables, from cautionary numbers to confident voices, the reality is clear. Miami's housing market isn't in freefall, it's finding its footing. This has been the Miami Real Estate Report, October 2025. I'm your narrator. Thanks for joining us.